My siblings, how are you guys doing? So, I was in this dividend group, and the guys were talking about high yield dividends. And in this video, I just want to give a brief description on why. Just because a company or a stock pays a high dividend doesn't always mean it's a good investment. But after talking to one of my buddies, he's looking to do the fire thing, retire early, purchase dividend stocks, and more so interested in the cash flow rather than actual, appreciation in assets. So I still think you want to have a diversified portfolio. That way, you're still getting growth with the cash flow, just in case we end up having low interest rates again, and then growth just out trumps value investing. But I think value investing is always key just because of the fact that you want to have cash flow coming in. Even if you lose, some of your initial capital, uh, once you gotta get into more complex option strategies, you'll find out that a lot of this stuff really doesn't matter. If you know how to chart well and you can choose some decent strikes and you can start selling some covered calls, but I don't want to get super complex on you guys. So I'm just going to try and keep it as minimal as possible and show you some of the reasons on why. With real life examples. I even got your annual return on these equities that I'm going to be looking at today. So um, hang on, let me just switch this thing on my computer real quick. Um, we'll just do retail. Anyways, so um, this is KMI. This is one of the equities that were on the list. They paid a high yield. Let me come on here and see what yield it says on here. So they're paying a 6.64% yield. So to kind of go back to basics on that, with a dividend yield, let's say you invest, $100,000. You know, theoretically, after your dividend yield for a year, you should make 6.64% on that capital. So you should make $6,600 for that year. So this was one of the stocks that was on the list. My data that I did for the year to year returns were from November 2011 till November of this year. So it's November 29th currently today. And when we look at the year to, as you can see, if we bought in November of 2011, we would have been up here somewhere. You can see that current price. Let me see if I can get like a little thing. You know what? We'll do a horizontal. I mean a vertical ray, and then we'll do another one where the day's data is that, and then we bought here. Current price is down here. So you can see we did lose value. We bought at 29, 63. The current market value is $16 and a penny. So what we'll do with that is I'll show you the annual returns on this equity, which is KMI. So as of November 24th, 2011, till November 15th of this year, if you invested $10,000 in the KMI, I don't know if they stopped paying a dividend at any time. I don't know the super complexities of what's happened throughout the last decade. I think this is a natural gas company, so I know that they're heavily correlated with natural gas commodities. But as you can see, if we invested $10,000, at one point we were up a decent amount. We were up maybe what is that? Like 17, almost $18,000. Well, up $8,000 from our initial investment of 10,000. But in 2015, I know gas. I don't trade natural gas, but I know oil took a huge hit. I don't know if they had any correlation with oil at the time, or if it could have just been natural gas. I don't trade natural gas. I don't really look at it that often. But you can see in 2015 they took a huge hit. and it's just been struggling to recover ever since. Right before in 2019, 2020, we were kind of coming back to our initial investment. But one of the things you have to be cautious of is there's still inflation, and if your investments aren't beating inflation, you're technically losing money. So in this investment would have been a horrible investment for us. I'm not saying it's a bad company, but for our portfolio, it wouldn't have been the most ideal investment, regardless of the yield. So then I'm gonna go to their competitor. I just found this on my little terminal thing for one of their nearest competitors. Now this is an interesting one. So this one wasn't on the list, but it was just a competitor of KMI. Now, as you can see, if we invested in November 2011, we would have been right here, right around current price. So in the last 10 years, we've pretty much hovered. Well, we've had some volatility to the upside, but it had the same thing in 2015. It kind of took a hit. That's why I'm thinking it had something to do with natural gas or maybe oil or energy. But as you can see, in the last decade, we've pretty much stayed at this same price, which to me is really interesting. But this company does pay a yield. I mean, a dividend. And you know what? Let me type it in. That way we can get see what their current one is right now. So their dividend yield is 7.91%. Now it's a lot higher than the KMI one, and it's also a competitor. But I don't want to go into all the little complexities. But I remember reading on there. Yeah, where is it? Yeah, they're correlated with natural gas, crude oil, blah 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 blah, pipelines, all that stuff. So they still pay a dividend, but when you look at it, even though our stock price pretty much stayed the same, when you look at the returns, we still got an annual return of 7.48%. So our initial $10,000 investment would be a little bit over 20 grand. And this is no reinvestment. This is just, drip, just reinvesting your dividends into this equity every year. We would have still came out on top. Now, the thing is when you're looking at stuff like this, yes, you're getting that cash flow, but when you're looking at these value plays that provide cash flow, a majority of the time you're not going to get that high growth because they're not, technically reinvesting heavily into R&D, like Apple or Microsoft or Tesla. I know Apple pays a dividend, Microsoft pays a low dividend, but Tesla, they don't pay a dividend, so you're going to have that high growth because they're constantly reinvesting and trying to become profitable. So then now we're just going to go into the next one, which is IBM. And as you can see, November 2011, we would have been right up here, almost at all-time highs, a couple months away from all-time highs. So I know we most likely lost money on this one. Not even just from the asset appreciation value, but just even with the dividends, it wasn't going to do anything. And later on, we'll go into some stuff with options on how you could have probably ended up still making money on this. But we'll just keep it simple for now. So IBM, yeah, we still ended up losing money. It's just been nothing but a roller coaster. I think in like 2020, I don't know if it was Australia or it was CNBC or something like that, was talking about kangaroo markets, just up and down, choppy. You hate to see this. You hate to see equity curves like this. Even with the dividend, it wasn't really doing anything. Now, if you just wanted it for cash flow, I mean, maybe. But the thing is you still want to have that appreciation of value. And you didn't get that with this equity. Now, ExxonMobil, I know for sure in 2015, this one is heavily crude oil. Let's see, November. We would have lost money on this one. We might have broke even on this one. Let's see what their dividend is. Ooh, their PE ratio is bad. So that means, anyways, we won't go into anything crazy, but their dividend yield is 6.05%. And then we come over here. You can see that their stock is taking a beating. I know they're heavily correlated with oil. So anything correlated with oil in 2015 was going to take a nosedive. 2008, there was some stuff going on with oil as well. I think it went from like 140 a barrel down to like 90 or something like that in 2008. But anyways, so our returns on this one were just underneath 2%. So, oh wow, even in 2015, our equity curve didn't really take that much of a nosedive. But at just underneath 2%, it's not really worthwhile investment just because of inflation. Like, I know like annually they typically look for a inflation rate of around 2% a year. So you pretty much just broke even on this. And the next one we'll look at is Western Union. So Western Union, I used to use this company all the time before PayPal and well, not before PayPal, but when we had to send money internationally, it'd always be Western Union. Now this was before Bitcoin, cryptocurrencies that I knew of. I knew about crypto in like 2014, 2015. But let's look at 2011. You would have probably made a little bit of money on this, to be honest with you. Let's see, November. Yeah, you're just underneath. I'm pretty sure they pay a dividend yield. Currently it's 5.73%. Oh dang, I had this thing open. I didn't even have to come over here, but we'll still come over here anyways. Just because YouTube likes longer videos. So wink wink hint hint. But this one is saying 411, so I'm not sure which one is actually correct. And I'm not about to log into my TD. I still have my personal information up on that one. So I don't know which one is real. I'm pretty sure that this one is probably a little bit more accurate. I have seen some issues with this little website right here. But anyways, let's see Western Union. So we invested $10,000 in November 2011 till November of this year. Our $10,000 would have turned to $14,382.43 for an annual return of 3.7%. We would have just beat inflation technically until this year, which inflation is through the roof. Oh, dang. Oh, man. My microphone is messing up. Dang it. Sorry, guys. All right. I'll edit that part out. Hopefully it didn't affect the audio. But, yeah. So then the next time I do a video, which to you guys might be a few days from now, but for me, I'm probably going to make it tomorrow. I'll go over some equities that did really well. And then I also wanted to show one that did somewhat decent. So Verizon, it had a huge appreciation of value. Just so you guys aren't thinking that this is going to be a doom and gloom channel. I'm not telling you to sell everything and invest in gold. I'm not about to do that. I want to show you guys some good, a little bit of good through all that bad with the dividends. So this is Verizon. They pay a dividend yield of 4.94%. So from November 2011, it's like right around here. So you can see that the appreciation and the value of the stock that we bought did appreciate in value from 2011. I'm not certain if they did any acquisitions or anything like that, but I do know Verizon turned up a lot. I know over here it was, can you hear me now? But anyways, that was just a little joke. You guys know I joke. But anyways, from 2011 till now, we've had appreciation in the stock value. And then we've also collected a dividend. So when we look on here, our $10,000 would have turned into $22,266.04 for an annual return of 8.3%. Now that's decent. That's almost keeping up with the S&P a little bit. So you would have been doing okay investing in this. You doubled your money. It took you a little longer to double your money than what would be ideal, but it's a safe investment. It's Verizon. Like a lot of these companies aren't going anywhere. their cash flows might be off. I don't know. Their management may have changed. I know IBM management definitely changed in 2019, late 2019, early 2020, when the lady stepped down as CEO. So, um, yeah. So I also want to do some videos on crypto. I know I've been studying that like crazy, like NFTs, metaverse, cryptocurrency, staking, like the whole nine, and my brain is just blown. And my mentor Ty told me to get into crypto in 2016, and I should have listened. He told me to put drop everything I'm doing and get into crypto, and I did not listen. Um, so if you guys have a time machine that I can borrow, let me go back, and I will do what he told me to do that time. But now I'm listening, and I'm going into crypto. But anyways, guys, that's the video for today. It's not bad to invest in dividend-paying stocks, especially if you're just saying, "Hey, look, I'm 60 years old. Or I'm 40 years old or 50 years old, and I just need some cash flow." You're not gonna go all in on one of these stocks. You know what I'm saying? So you're gonna diversify. You're gonna have some growth. You probably have some gold or some bonds, and you're gonna have a decent portfolio, or at least that's what I'm gonna teach on here. Have a decent portfolio of everything. Have some growth. Have some consumer staples, some defensives. Uh, just have a little bit of everything, please. So the more stuff you have, the likelihood of you actually going bust is super low. Um, Now, I'm not saying to over leverage or anything like that, but anyways, I'm gonna go into this whole spiel, and this is gonna end up being a 2 hour long video. But that's it for now. Talk to you guys soon. Namaste.